Hey everyone, it's Sharon, and I am here to talk to you today about cash flow. Cash flow is a really key part of your business, and it can help you make financial decisions so that you aren't scrambling all the time. So, let's talk a little bit about what is cash flow and what it can do for you. The first element of cash flow is all of the cash into your business. Now, when we say cash, of course, in ye olden days of running a business, you might have meant the actual paper money. But of course, cash is just the catch all phrase that we use now to talk about all of the money coming into your business, no matter how it's paid for by check, by credit card, no matter what. But the number one way that cash comes into your business, of course, is through revenue and sales. So when you book a client and they pay, when you sell a product and they pay, so all of that revenue, sometimes it's money that you have invested into your business, sometimes called an owner contribution. And the other way that it comes in is from places like investors. So if you are one of those business owners who's thinking about taking on a board of investors, that investor money would be cash in. And it can also be in the form of loans or lines of credit. And yes, even the credit card charges that you make, that is considered cash coming into your business. And all of this is, of course, cash. This portion of the cash in is, of course, cash that normally needs to be paid back. And that is when we start talking about cash out. So, what is cash out? All of that stuff we just talked about. So, all of your loan and line of credit payments, your credit card payments, your investor payments, all of your business expenses. So, if you maintain a profit and loss statement, or if you're ever looking at the profit and loss statement that you maybe pull from QuickBooks or Xero or Wave, any of your accounting software, all of those expenses, your rent, your payroll taxes, the taxes themselves, like your small business taxes, your quarterly payments, everything, all of your office supplies, your ink, your paper, everything, all of those little things that go into your profit and loss statement also come out of your cash flow sheet, comes out of your cash out. Other things that are included in cash out are inventory payments. So, inventory is a little bit different than cost of goods sold. I'm going to do a whole other video on cost of goods sold, though, so that it can make sense to you too. And I'll probably wind up doing an entire video on inventory because inventory is such a key component to the financial health of your business if you run a product based business. But in this case, if you picture your typical brick and mortar retail store, say a gift store, all of those products that are all over their shelves, that is inventory that had to be paid for. And you don't get to write it off on your taxes until it sells. So right now it's sitting in your business like an asset. So all of those are inventory and you had to pay for that, it comes out of cash flow. So it doesn't matter if you're a maker and we're talking about your raw materials, or if you're a product seller and we're talking about your finished goods, or even if you're doing both raw materials and finished goods combine, and it's all inventory. Other items of cash out I might have mentioned taxes. If you are not set up as an S corp, then it is also owner draw. So the money that you're paying for yourself to yourself is also coming from cash out. And depending on your business, different businesses operate differently. Didn't know I need to say that, but I did. But sometimes your cash out can include things like startup or expansion expenses. If you are starting a catering business and you need to buy a van, if you're starting a food pop up and you need to buy a food truck, if you're starting any kind of light manufacturing and you need to buy equipment, if you're buying any kind of property, sometimes that is measured differently on your taxes. Again, this is the kind of thing where I would send you back to a CPA or an accountant to decide where it goes in your business. But just note that sometimes this can be included in your cash flow and it would count as cash out. So, what do you do? So, the first thing that I tell most of my clients is that you just want to observe. So, you need to know what's in your bank account right now. You want to know how much you need to have in your bank account to cover certain expenses like rent, like payroll. And then what are you anticipating coming in and going out within a certain period of time, say over a month or over a quarter or even over a week? And then what you get to do is you get to manage it. So, cash flow projection is really not a passive projection. It is something where you are actively making decisions by employing it. So, you need to project your cash flow needs and possible payments over the next month, let's say. And I would actually recommend, if you've never done this before, that you just do it over the course of a month. And what you're doing is you're managing it to make sure that you'll have the money in your bank account so that you can cover all of the necessary expenses. And now let's talk about what cash flow means and what it means if it's negative. Because there's a tendency, I think, for a lot of small business owners, I know I've been in this position, to look at a negative cash flow and feel a certain way about it. Maybe feel really tense, feel kind of anxious, or feel like you're not doing the right things. But actually, looking at a negative cash flow, it allows you to make decisions about your business. So, sometimes what negative cash flow is akin to is being overdrawn your bank account, which is not the end of the world. It does happen, but it can also be costly, especially if your bank charges you fees. And so the idea of looking at your cash flow sheet and addressing negative cash flow is that you avoid those fees and you avoid not being able to pay some of your bills. So it's all about managing. So, one of the core things that you can do to manage your cash flow is to plan in advance for your inventory, whether it's finished goods or raw materials. And try not to tie up all of your cash flow in your inventory. It can be really easy to do, especially if you're in a creative field. I've worked in jewelry for years, and it can be really easy to just buy up all of the gems, the beads, the metals, the wires, and all of the components you need to make your work all at once. But it might be worth finding out if you could stage out some of those inventory payments over the course of time. You can also, in many cases, talk to vendors and find out if any of your vendors accept net 30 payments. And for some of you who are in business, this could be a great way of managing your cash flow. For others of you, if you are managing, say, a retail store, you're just going to need to know what ratios of what products you need on hand to what products you need to sell within a month's time. And those are calculations and ratios that you can develop for yourself and for your own store's needs. It's also the kind of thing that you can do a little bit of research into and find out what your target should be. The best thing you can do for negative cash flow is to follow up on any unpaid invoices. And I do know that for a lot of small business owners, this can be a very emotionally fraught. That you can that it's a difficult thing to manage when you are also trying to manage the relationship with whoever it is who owes you money. But if they owe you money, that money is yours, and it is worth taking the time out of your week to collect it. Another thing is that you can ensure that your pricing is actually supporting your business. It has happened a lot of times that I've gone over cash flow statements and cash flow projections with a client or with a student, and we've discovered that part of the problem is that their pricing isn't high enough to really cover all of their expenses. And so we're seeing, huge amounts of production and a high volume of sales, but there's too much money going out the door. And sometimes we can make a pricing adjustment and suddenly the cash flow problems kind of clear up. Another thing you can do is look into financing for your business. I talked earlier about how loans and lines of credit are actually part of your cash in. So it's worth it to look ahead to see where the holes are going to be. So, again, this is how you address a negative cash flow. You look ahead and you say, okay, in 2 months' time, it looks like I'm going to be negative unless I take an action. One of those actions can be to take on a microloan, either through a bank or through a micro lender like Kiva, or find out if your bank will extend you terms with the line of credit. I do like using loans and lines of credit over credit cards, not because I'm judgmental, but because it's a much better way of managing your cash flow. Especially in terms of loans, you have more solid known payments that you don't necessarily have with a credit card where you might be paying it off piecemeal. So taking on a loan actually allows you to manage your cash flow a little bit more tightly. Another thing you can do to address negative cash flow, let's say you're looking ahead to the end of the month and you're thinking, wow, I'm barely going to squeak by. Maybe it's time to have a sale. Maybe it's time to do more marketing. You could do a tabling event or an outdoor event, or you can reach out to all of your old clients and customers and find out what they need. You can run an email blast or two. You could run some ads, though ads can also add to your cash out. Or you could run a sale. Maybe it's time to run a private sale just to a small list of customers to see if you can boost your bottom line just a little bit. But that's another way of addressing negative cash flow. Another thing, of course, you can do, because the numbers can only go in two directions, right? They can either go up by increasing sales or they can go down by decreasing your expenses. So if you're projecting ahead and you're seeing a negative cash flow, it might be time to make some decisions about your budget. Is there anything that you can cut? Is there anything that's not an absolute necessity right now? Could you maybe take a smaller owner draw just this month in order to make sure that your business stays cash flow positive? All of these things are possible. If you are a maker, now might be a really great time to look at all of your unused tools or unused materials that you bought a year ago and you're not getting around to. This is a great time to go through all of that and decide, hey, maybe it's time to list some things on Craigslist or Facebook Marketplace and get rid of it. Maybe if you're a jeweler, now is probably a great time to sell off some scrap. And one of the best things too, and I say this about a lot of things when it comes to judging negative cash flow, but measure the age of your inventory. And of course, I do want to do a whole video just about inventory because, oh my gosh, it is quite the beast. But one of the great things you can do is to take a deep, deep look at your inventory and look at what's been around more than a year. If it's been around more than a year, it is time to sell it. It is past time to sell it, in fact, because a lot of older inventory sits on your books and you get taxed on that in the United States. So you want to make sure that you are churning through your inventory as much as you possibly can. So this might go hand in hand with a sale, with a discount or something, where you look at all of your oldest inventory and you opt to take that out first and put it on sale, or it's time to repurpose it into something new. So there's lots of ways of doing this, but just note that if you ever see negative cash flow, it is never the end of the story. Look at all of these things that you have choices to make about how you address your negative cash flow. So the other things you can do, so when to look at it. Every business owner is going to be a little bit different. I've worked in cafes and restaurants where you really needed to monitor it on almost a day to day basis because you were receiving fresh ingredients that you had to pay for and you're paying for staffing. And so you have to measure, how busy are we versus how much staff do we need versus how many ingredients do we need. So you might, if you run a business like that, you might need to be looking at it on a daily or at least weekly basis. Other people who are coaches or consultants or service providers maybe can get away with looking at it once a month or once a quarter. But I do recommend looking at it frequently in the beginning and what to look for. So it's great to look ahead and see, hey, when am I going to be really flush with cash? When am I going to have a lot of cash on hand? And to ask yourself what you can do with it. If you're going to have a lot of cash on hand for a while, you can make decisions about what's going to positively impact your business. Maybe if you see a really good cash flow month ahead, maybe it's time to invest in that equipment that is going to take your business to the next level and allow you to take on more business. It's a way of maybe scaling up without having to hire. There's a lot of ways of looking at it, but there's the thing to look for is, when am I going to be flush with money or when am I going to be out of money? And how to use it. So, when you see holes or negative numbers, like I was talking about the addressing negative cash flow before. So, this is when you would use a cash flow projection to make observations and then make decisions based on those observations. So, I'd mentioned, looking ahead to see when you're going to have enough money for that equipment. When do you have to curb your budget, or when do you really need more sales coming in? And the way that I view it is you look at your cash flow first and then spend later. So, the way that I often recommend that clients and students use this is before you make that purchase, before you plunk down the money on that next trade show or craft show, before you buy your inventory, before you buy your raw materials, But before you really pay for anything, take a look at your cash flow and put these expenses and put these sales into it to see how it really balances out. So, I always recommend using your cash flow projections as kind of a guardrail on your business so you're not overspending or even underspending. And of course, lastly, where to keep it. This is going to be a personal decision that all of you will have to make. Personally, I love it in the form of a spreadsheet. I've worked with other people who like the app You Need a Budget, sometimes called YNAB. They use it for their businesses if they're solo. I like a spreadsheet. Some people use Airtable. You can use QuickBooks has an automated version of a cash flow. It's not always great, I've found, for small business owners. It's usually more like executive level cash flow, and it doesn't always make sense because we have smaller bits of money coming in and larger bits of money going out. And so we might need to put our own eyes on it to make our own decisions. So, where to keep it is going to be personal. If you're new to making a cash flow projection, one of the things I recommend is that you use it a lot in the beginning. You want to get yourself into a habit of using it. So, maybe you don't have the kind of business that actually needs to look at your cash flow every day. But in the beginning, I would recommend doing that every day so that you stay on top of your numbers and that you get a better, more general instinct for when and what you can spend and how you can best spend it. I just want to say thanks for watching, everyone. If you got any value from this, please hit like and subscribe. Those likes and subscribes help so much. And if you want to learn more, you can pop over to my website, SharonZ-consulting.com, where I have other resources, e courses, and even one on one consulting. Looking forward to hearing from you. Thanks so much.